Most days, you're awake before the alarm, already mentally sorting through your entire day's schedule. There's the main job, the one that pays the bills but never quite feels like enough no matter how many hours you put in. Then there's the side hustle or extra shifts you're squeezing in, the late-night brainstorming sessions that leave you staring at the ceiling at 2 a.m. wondering if any of it is actually moving the needle or if you're just spinning your wheels. You tell yourself it's temporary, that if you just push a little harder, sacrifice a little more sleep, say yes to one more opportunity, the breakthrough will finally come. But months turn into years, and while your calendar stays packed and your body feels the wear, your savings account tells a quieter, more honest story. The raises get eaten by inflation and the slow creep of lifestyle upgrades. Unexpected car repairs, medical bills, or family needs wipe out whatever progress you thought you were making. And meanwhile, you look around and notice some people, not necessarily smarter, luckier, or working dramatically harder, who seem to have cracked a different code. They work their normal hours, they have actual lives outside of work, they take real vacations, and somehow their money is growing steadily in the background without constant drama. It makes you pause and wonder, is the constant grind and sacrifice really the only path to financial progress? Or have we been sold a story that keeps so many of us exhausted and exactly where we are? My name is Tan, and I spend a lot of time researching about money psychology, and finance. I've watched friends burn out chasing the next promotion or side hustle, and I've seen quiet, almost boring approaches turn into real freedom over time. What I've come to believe is that the biggest lever isn't always working more hours. It's building systems that let your money and your decisions compound without requiring your constant attention or energy. Today, I want to walk you through 7 lazy ways to build wealth. Approaches that often outperform the hard hustle because they remove the biggest obstacles: inconsistency, emotion, and the slow leak of trying to do everything manually. These aren't shortcuts in the get-rich-quick sense. They're smarter defaults, things you set up once, tweak occasionally, and then let time and structure do what they do best. Stick with me because by the end I think you'll see your own situation a little differently, and maybe feel a bit more hopeful about what's actually possible without sacrificing the rest of your life. Let's start with the foundation, the thing that makes almost everything else easier and turns good intentions into automatic progress without needing heroic discipline every month. The first lazy way is automating your savings and investments so the right things happen without you having to decide or remember every single time. How many times have you meant to move money into savings or investments at the end of the month, only to find life happened? A birthday, a sale, an unexpected expense, and the money was already spoken for. We're human. Willpower is limited, and when you're tired or stressed or excited about something new, the responsible choice often loses. Automation flips that. You decide once, say 15 or 20% of your paycheck goes straight to a retirement account or brokerage the moment it lands, and then it just happens. No decision fatigue. No, I'll do it next week. It becomes as automatic as your rent or phone bill. The beauty is that it removes you, the fallible human, from the equation as much as possible. I had a friend named Marcus who was the classic hard worker. Long hours in sales, always chasing the next deal, always telling himself he'd get serious about money once things calmed down. But things never calmed down. Then one day he set up automatic transfers. Every payday a fixed amount went to a high-yield savings account and another chunk to a simple index fund. He didn't dramatically increase his income or add an intense new side hustle. He just removed the choice. 5 years later, he had a solid emergency fund and a growing investment account that had done most of the heavy lifting while he focused on his actual life. The crazy part? He barely noticed the money leaving because it was already allocated before it hit his main checking account. His future self was getting paid first, automatically. This beats hustling harder because when you rely on manual effort, your savings rate swings with how disciplined or motivated you feel that month. Some months you crush it, other months you don't. The inconsistency kills the math of compound growth. Automation creates ruthless consistency, and consistency is what compound growth loves. It also protects you from lifestyle creep, one of the sneakiest wealth killers. That extra money from a raise or bonus. If it's automatically routed before you see it and get used to spending it, you don't have to fight the temptation to upgrade your lifestyle immediately. The system does the emotional work of protecting your future self. The actionable takeaway is straightforward. Open the accounts if you haven't, a retirement plan through work, or a brokerage and IRA on your own. Pick a sustainable percentage or fixed amount. Set up the automatic transfer on payday. If your employer offers direct deposit splits, even better. Review once a year or when income changes meaningfully. That's it. Do the thinking once so your money keeps showing up without new motivation each month. Building on that, the second lazy way is to stop trying to be a stock picker or market timer and instead put your money into simple, broad market index funds or ETFs and let the market do what it has historically done. This feels almost too passive at first. Just buy the whole market? Yeah. Over long periods, the vast majority of active stock pickers and day traders underperform a simple low-cost index tracking the total stock market or S&P 500. Not because they're not smart. The market is efficient. Fees eat returns over time, and human psychology makes us buy high when things feel exciting and sell low when they feel scary. Picture someone who spends hours every week researching individual companies, reading earnings reports, trying to catch the next winner or avoid the next crash. They might have stretches where they feel like geniuses, but data shows that over 10 or 20 years that intense effort often delivers worse results than someone who automates investments into a couple of broad ETFs and then goes about living their life. The lazy investor gets instant diversification across hundreds or thousands of businesses. When some struggle, others carry the load. Fees are tiny, sometimes just a few basis points, which over decades and with compounding makes a massive difference compared to higher fee active approaches or constant trading. I talked to Priya, who had tried the active route for a while. A handful of individual stocks she followed obsessively plus some crypto bought during a hype cycle. The volatility kept her up at night. Every red day felt personal. Then she simplified into broad, low-cost ETFs with dividends set to reinvest automatically. The mental load dropped dramatically. She checks maybe once a quarter now. Her returns became steadier and better over the long run. The market did the work. She just stayed out of its way. This matters because time spent researching or timing is time not spent on higher leverage parts of life. Deepening career skills, relationships, health, or rest so you can show up better everywhere. Hustle culture glorifies being busy with money decisions. But busyness isn't effectiveness. A simple index strategy frees mental and emotional space while historically delivering solid long-term growth. Actionable step. Look at low-cost total stock market or S&P 500 ETFs. Set automatic investments to buy a little regularly. Resist the urge to tinker constantly. The laziness protects your returns and your peace of mind. The third lazy way builds on the first two. Practice dollar-cost averaging and genuinely tune out the noise. Dollar-cost averaging means investing a fixed amount at regular intervals no matter what the market price is doing. When prices are high, your dollars buy fewer shares. When they drop, you buy more. Your average cost smooths out over time and you remove the impossible task of perfect timing. Think about someone who had cash on the sidelines in early 2020 waiting for the absolute right time after the initial drop, or who got nervous during a later dip and paused their investments. The ones who kept going, treating contributions like a subscription they didn't cancel even when headlines were negative, ended up stronger a few years later. The market recovered and hit new highs. Shares bought during lower periods grew the most. The real win wasn't just the math. It was emotional freedom. They didn't have to obsess over news or make high-stakes calls under pressure. The system kept working even when confidence felt incomplete. I've seen this in my own smaller investments. There were periods where the market felt shaky and every instinct said maybe pause this month. But because it was automated, the investment still happened. Looking back, those were often better entry points. The system protected me from my worst impulses. Hustling hard with investments often looks like constant checking, adjusting, and second-guessing. The lazier version is deciding on an amount and frequency, setting it up once, and then living your life. Check in maybe twice a year if your situation changes. The market and time handle the rest. This beats pure hustle because you can't reliably control short-term market moves no matter how much research you do, but you can control your behavior and consistency over long periods. People who build lasting wealth set a boring, repeatable process in motion and let it run while they focus on parts of life that need their presence. Now the fourth lazy way. Tilt some of your portfolio toward assets that can generate income or appreciation with minimal ongoing management from you. This could mean dividend growth ETFs from companies with long histories of increasing payouts, or REITs for real estate exposure without dealing with tenants or repairs. The common thread is owning pieces of things that can pay you or grow while you're doing other things with your time. Imagine a portfolio portion designed to throw off growing income or appreciate steadily. You don't always need to sell shares later to create cash flow. The assets can do some of that work. With dividend growth, you're often buying stable, profitable businesses that have to keep earning to keep raising dividends. It compounds quietly and reliably without flashy short-term stories. Someone I knew started small with a quality dividend ETF in her early 30s while building her career. She didn't put in huge amounts at once. She added consistently through automation. By her mid-40s, the dividends covered a meaningful part of her monthly expenses, not from one lucky pick, but from giving time and consistency to quality holdings. After the initial setup, she did little active management. Reinvest dividends early to accelerate compounding, then adjust later if you want income. The companies and fund structure handle the operations. This matters because one of the biggest lies of hustle culture is that the only way to have more money is to trade more of your direct time. Income-producing assets break that link. They create leverage. Your capital works while you sleep, travel, parent, or rest. Unlike a second job, it doesn't require your ongoing daily energy. Actionable, research low-cost dividend ETFs or quality dividend companies. Add them gradually to your automated investments. Or explore broad REIT ETFs for real estate exposure without the headaches. Start small, stay consistent, let the income and growth compound. The system does more of the work after initial decisions. The fifth lazy way can dramatically accelerate everything else with almost no extra daily effort once set up. Maximize tax-advantaged accounts and strategies. Contribute to retirement accounts that offer tax deductions now or tax-free growth later. Capture any employer matching contributions, free money, and use other vehicles like HSAs where eligible. Two people can earn similar incomes and invest similar totals, but the one who routes money through tax-advantaged accounts consistently ends up with substantially more wealth decades later because less growth gets taxed along the way. The government created these incentives to encourage long-term saving. The lazy wealthy take full advantage without overcomplicating. They capture the full match, fill available IRA space yearly, and let tax benefits compound with returns. A couple I know started in similar situations in their early 30s. One maximized every tax-advantaged option and automated contributions. The other invested mainly in a taxable brokerage and didn't prioritize matches or space as aggressively. 20 years later, the difference in net worth was substantial. Not because one worked dramatically harder, but because one let the tax code work with them instead of leaving money on the table. Initial setup took some research, but after that it ran mostly on autopilot. Taxes are one of the largest lifetime expenses, yet we often treat them as fixed rather than something we can structure around proactively. Using these accounts isn't shady. It's playing the game as designed. Actionable. If your employer plan has a match, contribute at least enough to get the full match. An instant return nothing beats. Open and automate IRA contributions if room remains. Explore other available incentives with the same set-it-and-let-it-run mindset. Do initial research or a one-time fee-only advisor chat for clarity. Then let the structures do their job. This is one of the highest return-on-effort lazy moves. The sixth lazy way is creating or investing in assets that can scale and generate returns without requiring your constant linear effort going forward. This could be digital products like online courses, ebooks, or templates based on skills or knowledge you have. It could be content on platforms where evergreen material keeps attracting viewers or customers over time. Or investing in businesses or funds that operate at scale so your capital participates in that leverage without day-to-day management. The core shift is moving some energy from pure time for money, hard cap, to things that keep working after the initial creation or investment. Think about someone who spends focused months creating a useful online course or ebook. The upfront work is real. But once it's live with payment processing and discoverability, it can generate sales or revenue for years with minimal ongoing maintenance. Occasional updates, light automation for support. One creation period produces multi-year returns. On the investing side, Capital in well-run businesses or diversified funds means participating in the scale and work thousands of others are doing. The lazy wealthy understand that not all income is equal in ongoing energy required. Some demands you keep showing up indefinitely. Scalable forms are designed to flow with less daily involvement once the foundation is set. I've seen people build modest digital assets on the side while keeping their main job. They created something useful once, put reasonable systems in place, and let platforms handle delivery. Years later, those assets still contribute meaningfully to income and net worth. The contrast with pure hustling is clear over a longer horizon. The intense hustler may generate more cash in a busy month through sheer hours, but the asset builder often gains more freedom and total wealth because earlier efforts continue multiplying. Actionable. Look at what you know or problems you can solve for others. Explore platforms to turn it into a digital product or content asset that can sell repeatedly. Or invest in creators and businesses you believe in through accessible vehicles so your capital participates in scalable growth. Shift some effort from purely linear activities to ones with built-in leverage. Do the higher leverage work upfront. Let the asset carry more of the load going forward. Finally, the seventh lazy way is the glue that determines whether the others deliver. Embrace patience, design good defaults into your financial life, and do infrequent but high-impact maintenance instead of constant tinkering or reacting to every headline. Choose a simple investment approach and rebalance or review only once or twice a year. Set up sinking funds or automatic allocations for predictable big expenses so life doesn't force high-interest debt or derail progress. Review major decisions like insurance, big debts, and career compensation on a sane annual schedule rather than living in constant financial vigilance. Let inertia and good systems work for you instead of fighting bad defaults. People who build wealth with less visible stress often design their financial life so the easy default path is the wealth-building one. They don't rely on heroic daily discipline. They use structures and automations that make good choices the path of least resistance, then give those systems time to work without constant second-guessing. I've noticed in my own life and talking with others that the periods of most meaningful financial progress weren't usually when I was most on top of every detail or checking accounts obsessively. They were when I had good simple structures in place and turned attention toward work I cared about, relationships, rest, and creativity. Money and progress kept compounding because defaults were set right. Pure hustling without good defaults often feels like running harder on a treadmill set at a steep incline. Lots of sweat, not necessarily faster progress in what matters. The lazier but more effective approach is spending focused time fixing the settings first, then letting the machine do more of the work while you live. Those are the 7 lazy ways that tend to outperform constant grinding for most people over the long run. Automation as the base layer for consistency. Simple passive investing through broad low-cost indexes. Dollar cost averaging with emotional distance. Income producing and appreciating assets. Tax-advantaged structures. Scalable assets with leverage. And patience plus good system design with light maintenance. None require 80-hour weeks or sacrificing health and relationships. In fact, they often work better when you don't force everything through sheer effort alone. The most powerful moves feel almost boring at first. Set something up thoughtfully and trust the process and the math that has worked for patient people for generations. You don't have to do all 7 at once. Pick one that feels most doable right now. Set up that first automation. Open the simple investment account and start automatic contributions. Make sure you're capturing any employer match sitting on the table. Explore or create a small scalable asset if that's your lane. The compound effect of consistent low-effort actions repeated over years quietly turns ordinary financial lives into ones with real freedom and breathing room. It won't feel dramatic in any given month. But one day you'll look back and realize the systems you put in place did more heavy lifting than all the grinding ever did. And here's what actually matters most in real life. When your money starts working more effectively in the background because you've set up these structures, you gain something far more valuable than numbers on a screen. You gain real options. The option to keep working because you genuinely want to, not because you have no choice. The option to say no to things that would drain you. The option to be more present for the people and moments that make life worth living. The option to rest or explore without constant background financial stress. These lazy but powerful ways ultimately help create more life and margin, not just more money. You don't have to grind yourself into the ground to get there. You just have to start making the quiet, high-leverage decisions to set up the right systems one at a time, and then let them work while you live.
Thanks for spending this time with me. If something here resonated or gave you a clearer picture of what might actually work better for your situation, that's the real point. Make one small move if it feels right, and I'll talk to you again soon.